Hey everyone, and welcome back to the channel. We're getting plenty of questions coming in from the community, and those questions are all around what's going on exactly with the volatility in the stock markets, crypto markets, and commodity markets right now. This increase in volatility is not characteristic for December, and many people are wondering where the Santa rally is. In today's video, we're looking at the key supports that have just been found through the previous session and really breaking down the technical analysis and our understanding of the markets together. So stick in and get ready because this one is going to be a good video. Stay tuned, guys. See you soon. All right, everybody. Well, welcome back to our market recap for the 20th of December, 2021. And when you're talking about markets, the best place to start is the biggest market in the world. And that, of course, is the US market. Let's take a look now at the stocks that were moving the session. And it was clear that it was pretty much everything across the board that was mostly down. Tesla down 3.5%. An incredibly important support was reached. We'll talk about that later in the video. Financials were down pretty hard. Energy was down. And really every index took its toll. The futures was what led it. So the Monday futures were down as much as 2+% on some major indices. And we saw that follow through into trade in what we call the retail hour and just slightly after that. So the IWM, the Russell 2000 small companies, that was down as much as 2.8% before recovering. The S&P 500 hit key supports, the weekly 20 moving average. We'll take a look at that later. The Nasdaq also, and everything improved into the day, which is a positive sign for markets. And while it looks really negative, we did hit some key supports that we'll see soon. Which sector took it out? Well, energy was the worst. Yes, US oil and Brent certainly took a dive. That was easily the worst performing in the markets across the board. Energy down as much as 4.5%. Even it recovered. But we need to remember, energy was the best performing sector in the mains for 2021. So it makes sense there's some volatility at this stage. Consumer defensives such as staples, utilities, and communications were the best performing. IBB Biotech continues to hold very well after a really nice breakout last week and some strong action. And then we had the rest through the middle. But let's get stuck into the technical analysis because I think we need to understand what the markets are telling us right now. And one of those things is, of course, we do need to be partially fearful. When you have the VIX, which is the volatility index for anyone that doesn't understand it, this shows us whenever it's above 20, we need to pay attention. So when we're above that 20 line, effectively fear is coming back into the market. At that stage, the markets will move quickly, they'll have increased volatility, and if you're not prepared for that increased volatility, then sometimes it's better to stay away. But that means 1, 2, even 3% moves on the index are not uncommon when it's above 20. The good signs are for the Monday session was that the market did increase in volatility and then quickly decrease throughout the day. So we saw that fear that was initially there dissipate immediately, and buyers start to come at the close. Remember, buyers at the close means Wall Street is purchasing for the day. Let's move over to silver and gold, understand what's going on there. So silver and gold, sometimes seen as a hedge against the market, not so much in the last couple of years. They were not strong. They were actually weak. They fell back off. And this is because when we had the FOMC meeting last week, these had fake outs. Effectively, they went low and then they quickly reversed and they came straight up to our resistances. 2260 on silver has always been our technical resistance now for quite a few weeks. We've been watching this and we're waiting for a closure above this to show us participation is through. Gold is very similar. We have that 1810. There was a good day trade last week and then we got a full rejection. You'll notice at this stage it looks like it's going down. You'll say, Tom, that's a pin bar or a shooting star. That looks pretty weak. Yeah, it does, but the problem is, where are we? We're in the middle of nowhere land for gold. We basically have moving averages all sitting on top of each other. These can cause what you call dynamic support or dynamic resistance. That means that it's in a zone of, I would say, stay away, wait, and reassess once we get clearer pictures. If we get above 1810, then participation could come through. And when you're on smaller time frames, it's going to make more sense. Look at something like a 2-hour time frame. Look at the resistance. Look at how it sold off that zone. If it breaches that, there's plenty of what we call blue or green sky above. That's the kind of area that you want to be getting into. For some gold traders, they'll be watching this with a lot of intent. They'll be looking for turnarounds right where it is right now, around this 1790 to 1793. They'll be looking for lightning bolts, double bottom pattern, some form of stabilization, and then trying to buy that back up to 1810. But be careful, because there are mixed signals, and when you've got mixed signals, sometimes it's better to stay away. Another one was oil. Now, oil rebounded very heavily. We'll go to the daily chart here and you'll notice it really fell off. Like, it was down quite a lot through the session. If we actually take the percentage down, it was up to almost 6% here on US oil, and then rebounded over half of that. That's a good sign, because of course it did put in a low and found buyers immediately, but it's a bad sign that it didn't fully reverse. If it fully reversed, we're talking about a different story. We're at a point where previous resistance is now potentially going to become an area of zones. We had previous resistance becoming support, and now it could be resistance again. Let's scroll into the 1 hour to pack that and unpack it and really talk about it a little bit more. So here is the problem zone. Previous supports, previous resistance. Where are we now? We're exactly there. That previous support's acting as a point now where the market may sell off from. Obviously, buyers may push this back through, pull it back down, and then we're looking towards that 73. But I think this is where you have to make a decision. What type of trader are you? Are you a day trader or a scalper? You'll be interested in this zone if you are. If you're a swing trader, you're probably more interested in, let's get above 73, and there's plenty of upside potential there, because 73 is just such a clear level. It's what we call a participation level. We've got resistance, 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 resistance. That's 1, 2, 3, 4, 5 times of touching. Once something closes above a key zone like that, it tends to fly. And a lot of people don't understand, if they come from a fundamental background or just looking at price in general, how sometimes a stock or a commodity can ramp up really, really quickly, and all of a sudden it's up 20, 30% in a few days. A lot of it is understanding the price action, the supply demand, the key levels where if something is broken, it really makes a huge difference. And that is something that you get with skill, with time in the charts, and of course, when you can recognize the key psychological levels and the key resistance, support, demand zones. So think about Tesla. Where are we right now? Well, interestingly enough, we're at a previous resistance that's acting potentially as support. We close around 900. Some people are saying we closed under 900. Look, 899.94, it's close enough. So we've basically closed right on the zone where you expect some buyers to come in. We also have the second area behind it, which is this trend line that's going up. That area is also of interest should we close underneath 900 in the next couple of sessions. But a lot of people are probably starting to freak out about Tesla, and they're saying, well, from top to bottom, we're now down 27%. Is this unusual or scary for Tesla traders? It's not really. If you're new to Tesla, then you have to really start to think about why you're not looking at the left-hand side of the screens, because it's done it before. It's gone down upwards of 40% after having a mega run. When something goes on a huge run, especially a massive one like this, where it's sometimes putting on as much as 100% on the stock, when it starts to sell off, it does so in style. It really gets down there. So to predict the bottoms or to predict the levels, you've got to put in place some really big procedures. How do you find these supports? And when you do, what types of things are you looking for? Now, we teach the concept of double bottoms, the concept of lightning bolts, the concept of really waiting for a pattern or some form of base accumulation with potentially even volume to show you that floor. But for day traders, they might look in here and say, well, I like this 900, which at this stage, it didn't really buy off yet. I mean, it really didn't. It should have actually found stronger buys, you would think, at 900. A bit weird how it did there. But in the next session, let's say we start to see some ramping, momentum-based traders and algorithms will start to get involved. And that's what day traders and scalpers will try to take advantage of around this 900 level. If we breach underneath 900 and we get a daily close, let's say like an 880 or an 890, next stop could be our trend line. But at this stage, we're on support. Tesla is interesting and certainly worth a look in next sessions with your own systems and paying attention to, of course, the charts. Now, a lot of people are bringing up Apple as the sign that the markets are going to crash. Apple is in many ways overpriced. You may disagree with me. Go look at some of the fundamentals, the PE ratios over time, just some of the ratios. Now, it was cheap in comparison, considering its growth for a lot of 2021. In fact, if you'd come in and bought in July 2021, you would have really done very, very poorly. And you could have gone back to January 21 or even certain points in 2020 and not even been up that much throughout the year. The problem is it's gone on an epic heater recently, and many people are calling this a double top, and rightfully so. By most technical standards, it is. You've got a resistance, you've got a retest of resistance, an intervening trough, and you've closed below. And we have signaled this quite a lot as showing us there's some signs of weakness in the market. Now, I don't really like to bet against Apple, but it is important to recognize these signs. We've hit the daily 20. You know, if we close underneath the daily 20, at the same time that would happen, most likely the Nasdaq and the S&P 500 would also be closing under really key zones. So this is something we want to be thinking about. Another thing you want to think about in Apple is where does it like to come back to? And that is the weekly 20 moving average. We've seen it hit this level many times after going on extreme heaters, e.g. over here where it went on a big run. Eventually it comes back down. And that is still quite far away. In fact, percentage-wise, we're around, I think around 10% almost, 9.35% away from the 20. So Apple, while it's a great stock and many people will hold it long term, as a day trade, unless you want to go short, it can be a little bit scary around this zone. See what you guys think. Let me know in the comments down below. Do you think Apple's overpriced right now, or do you think it's pretty cheap? Volume is high, no doubt. It's on a very key level, being the 20 moving average here. But do you think this stock is too high and this double top is going to come through? Because that double top pretty much predicts back to the weekly 20 moving average. We'll find out. Apple's just a bit weird right now. Another very strong sector is semiconductors. A lot of you will know Nvidia. Nvidia has become a very big trade for retail traders and obviously been a 3x plus in 2021. What's happened here though with semiconductors is that they closed, well, it looks like they closed underneath, but this is where there is a small delineation between how a closure works. We have here the semiconductor sector. This is a very important sector. You want to follow it. Nvidia is a huge part of this, and it kind of looks like the chart itself. It's all about this daily 50 moving average. Now you might say, but it's closed underneath. It has, but it gapped underneath and it actually closed bullish, showing signs still of bullish sentiment. We've seen this plenty of times. The next day can actually be bullish again, and it's why it's important to wait for the close. You might find that tomorrow this is right back above this zone, closing higher, and that this may have looked like a fake out, but it didn't actually show negativity. If it was a bearish candle, yes, okay, then we're talking about going back to this previous resistance. But there is a difference between the way the candle closes, and it's super interesting. So around that 275 is the next support, should we get another bearish candle. And again, this will signal some weakness in the semiconductors if we do end up having it. Still kind of on support at this stage. ARK-K is coming into our analysis as well right now, Cathie Wood's fund. I'm not so much you have to go and think about Cathie Wood and the way that she does things, but I think what this really is showing us is hyper stocks right now. So that is a lot of stocks that have been the most hated in 2021. Not even arguably, some of these stocks are down 60, upwards of 80% even on some of them in her portfolio and other portfolios out there. And hyper stocks were all about 2020. And then it's funny how the next year, no one likes them. They become overpriced, no one wants to buy them, etc., etc., etc. So the reason we bring it up is there's been some decent trade volume recently on the fund, and we also have a pretty nice support and a chance here for a double bottom. Now, a double bottom would only happen if you get through 103, but it's like a double bottom within a double bottom. You have a lot of congestion here on the right, on the literal left-hand side or the right-hand side of this chart, and that could then point to further strength into the 103.56. And if that then breaks, possibly this sector or the hypers in general might be coming good. If you want to think about some stocks, you can go have a look at Twilio. It's got some good basing that's been forming there in the last couple of days. I went through it in the community. I think that stock, while I'm not personally saying you have to go buy anything like that, it's just one of those ones that you are starting to see base formations across these hypers. So ARK-K, we will watch this quite a lot more. And remember to subscribe if you're interested in what you've heard so far, and if you're enjoying the channel just in general. If you enjoy the information, the community, all of those things. You guys make it ultimately, and you make me present these videos daily on the show. Let's think about IWM. Now, a lot of people are sending this in to me as well. They're saying, Tom, it's Wyckoff distribution, and you would not be incorrect. Wyckoff distribution is effectively, you've got like a channel, and usually you have a few little kind of falsy breakouts, specifically one like this, to interact and cause max pain. So what max pain is people buy it like it's a breakout, and then it doesn't actually continue on. It comes back down and then breaches low. Now, because the Russell 2000 is small companies, what this ends up telling us is it's like the health chart of the markets. If the small companies are also going up, it shows a bit of breadth in the market. That is that everything's kind of rising with the tide. It's a bit healthier. And if the small companies start to show weakness, this can be where you see crashes. And we know that this is at absolute pivotal area. I mean, it doesn't take a rocket scientist to know that there's some key support around here. The good news is, while there's increased trading volume recently, we did end up seeing a bullish hammer. If we get follow through, as in we get it to close or move above this little candle here, then we may actually see some strength come back into this market. We've been talking about IWM so many times. Every time we say there's potential, we don't see the follow through. Unfortunately, that can be trading. It can take a while to get the signals that can show us to go long. 220 remains a key point of resistance. We obviously have that high of the previous session. We could be trying to fill the gap here a little bit as well for day traders and scalpers. But if we close above 220, that's a big deal, and we know where the big one is. And that's going to be around that 225, 226, a very key zone there of resistance. And IWM is at what I guess you would say deep support. Will it hold? Time will tell. And one that we have to not ignore for recent or coming weeks. Let's move over to the QQQ, or the Nasdaq as many people will know it as. Basically, we have here a big level of support, and we did see buying come back in. So from the top down, what have we got? We've got resistance becoming support. And when you look at the weekly, you bring on the weekly chart, the weekly 20 moving average is being tested. This is the zone. If buyers are coming in, they have to start buying at this stage. We saw Wall Street buy into the close. Basically, you will have, no doubt, some form of futures green action, you would think, throughout the session here. And this is where you're going to get that kind of accumulation and hopefully some buyers coming back in. If there's going to be a Christmas Santa rally, it has to happen around this zone. So it did end up buying. If it closes underneath this area, especially on the weekly, well, we could be looking at a much deeper correction. So time will tell for that. A lot of people will be looking for the gap close. That is to push it back to 383 in the next session. So basically a movement up here. If it gets through 383, that'll be a big deal. We'll watch it with the S&P 500. And if you scroll down to something like the 15-minute timeframes, you can kind of see that Wall Street was happy with this level. It basically double bottomed on the 5-minute. It then started bouncing up, and in futures action, it looks like we are actually getting a closure above this zone and further follow through. So we probably open the next session somewhere around this level here. Deal with this. If it becomes resistance and we breach through it, that's a good sign towards the bulls. And if we start selling back off, and especially if we close underneath these previous lows, the bears are really in control of this market. And this whole Omicron situation, everything else, the FUD that's going out there will really be pushing for a red Christmas effectively in a period of low liquidity. That could be a bit scary. S&P 500 weekly 20, we've mentioned it so many times. It's come back down, it's hit it, it's bounced off it, it's moving towards probably filling that gap, which you can see here. And if we scroll down into something like a 2-hour chart here, you guys know what the deal is. It's all about 4,600, then it went underneath. So it all becomes about weekly 20 and 4,500. We go back up, we test this level, we breach that level, positive signs. We sell off here because that's where the bears will try to come in. Could be some good day trades and scalps all around this 4,600. And that will be the zone to watch for the Tuesday session. Once we get more information, we'll be able to find out whether the bulls have fully got it back or the bears really push it down. Are you a bull or a bear for the rest of the year? Let us know in the comments down below as well. I really want to know that. Bull or bear for the rest of the year. That is till the end of December. Let us know right now. Let's see what everybody thinks. Let's move over to the crypto markets. Bitcoin here. Bitcoin weakness is what we should be calling it. A series of lower highs or lower peaks. It's not all bad, but it certainly isn't good. This is a weakening market. You look at Cardano, it looks almost the same at around that 120 rate. We have weakness. We need to see strength. Have we got any strength? No. Do the bears have full control of the market? Well, the rallies definitely are weakened, but they don't have full control yet. We've got some base formation. We have a 48,000. We know where the next resistance is. A closure above this will be good for day traders. For bigger investors, they're probably looking somewhere in that 52K. And really, we just need a win. There hasn't been, I mean, we've got lower high, lower high, lower high, lower high. We need a higher high. And until you get a higher high, you're not really changing trend. So I think 48K is one of the key points. You can see this downward trend. You can see what it is. It's basically a descending triangle. I'm sure a lot of people are yelling at the screen. It looks like a descending triangle, Tom. You're right, guys. That shows weakness. But if you snap this, then all of a sudden, descending triangles can be traded both ways. Remember that. It's not, a pattern is just a pattern. It's how you interpret the real actual price action. And that's very important. Ethereum, very similar, weakening market, slightly less weak than Bitcoin. You'll notice it's bounced without having to go down to the lows again, but no significant breakouts of either of these lines, this one here or this triangle here. So we've got some problems in the Bitcoin market. Should it come to life, it's really got to do so now. And it's going to be pretty important stuff. If you enjoyed today's video, please remember to subscribe, smash that like button, guys, and I really appreciate all the support. We'll be doing another live session as well for the close, half an hour before the close into the back end of the markets and the post. So that'll be very, very good, and we'll see you soon. Bye for now.